Hope everyone's doing well. This is the Emini review for May 22nd, 2024. And before I get into the price action, bar by bar analysis, I just want to take a few minutes to talk about how today was a Fed report day. The FOMC minutes was released today at 2 p.m. And when I say Fed, I'm referring to the Federal Reserve, which is the central banking system of the United States. And so today the FOMC minutes, and FOMC stands for Federal Open Market Committee, which is a board made up of 12 members, including Chair Jerome Powell. And so the FOMC minutes tells you what Jerome Powell and the other members decided to do with interest rates. And the FOMC meet 8 times a year, which is about every 6 weeks. And this report is released 3 weeks after the actual meeting. And it's a summary of what took place during the meeting and why they made the decisions that they made. And this report is always released at 2 p.m. Eastern Time on a Wednesday. And by the way, another typical time for news reports that can affect the market is 10 a.m. Eastern Time. But I don't want to get too much into the FOMC today, but what I do want to say is when the economy is in a period of inflation, the Fed will hike interest rates, which means they'll increase them. And why would the Fed hike rates? So during times of inflation, the Fed wants to slow economic growth, and one way to do that is to make it more expensive to borrow money. Now, what interest rates am I talking about? Any loan you may need for any big purchases, like a mortgage, car payment, education, or starting a business. That's just a few common examples. There's other types of loans too. But if you borrow money from the bank, they charge you for borrowing their money, and the amount that you repay them is a percentage of the principal. The principal is the amount that you borrowed, and the amount that you pay them back on top of the principal, that's the interest. And so the main focus of the Federal Reserve is to set interest rates and promote a strong economy and minimize unemployment. The Fed also manages the money supply and regulates financial markets. But that's about all I'll say about the Fed today. And why am I saying all of this? How does it affect trading and how does it affect the market? Going into any news report, I don't investigate anything about it. But I do want to be aware that there's a significant news report that will affect the market, but that's the extent of what I know. There's no point in trying to predict what the Fed will do and how the market will react. But all you really need to know is that the market will probably react in a big way. And so what I do is I'll take a look at the economic calendar on marketwatch.com. And I don't look at that every day. And what I do is I note when these big major reports are, like the FOMC minutes. And I always double check on Wednesdays because that's when the FOMC minutes is released. And so one reason why I don't look into the details while I'm trading is because one, that would be a distraction. And two, the reality is there are computer algorithms that are programmed to analyze the report instantly as it's released, among other factors, and they'll place trades based on them, and plus the volatility in the market typically increases significantly. And since I can't think or react as quickly as the computer algorithms can, and you mix that with the unpredictability of the report, mixed with the increased volatility, that all will reduce, if not erase, my edge. And this is Al's advice that I'm sharing. And so what I do and what he says to do is just make sure you're flat, which means not holding any positions in the market, long or short. And just make sure you're flat at least 15 minutes before and after the report. And again, I pay no attention to this news when I'm trading, and the information does not influence me at all. I just watch the price action on the chart. And it's not a big deal that you don't trade the report, even though the market moves quickly and it moves far. The reality is there's plenty of opportunities and plenty of trades leading up to and after the report. So there's really no need to trade the report, but traders can. The price action really remains the same, but traders will reduce their position size if they do. So with that said, let's look at the daily chart for today. So as I've been saying, on the daily chart, we have this really tight bull channel. But if you look at the past 4 bars, and you look at where we are at all-time highs, the market's starting to go sideways. We've had 4 or 5 bars basically all overlapping each other. It's a tight trading range. And because of that, there are probably sellers above yesterday's high and buyers below yesterday's low. Probably buyers below the 17th as well, buyers below this breakout bar. But my expectations going into the day was for it to be a trading range day. This is, you can call it a high 2, maybe a high 1 above the 17th, and then maybe a second entry here. But I'm really not expecting buyers. And the reason I'm not is because I mentioned this in a previous video. This tight bull channel, we then had this trend line break. I'll get rid of some of these lines. We had a tight bull channel and then a significant trend line break. And the expectation after the trend line break is not that we're going to continue to fall all the way down here. What's more likely is we'll get a retest of the trend's extreme. And this is how major trend reversal is set up. But the pattern is really just like a high 1 on a higher time frame. And so what happens is you have bulls buying all the way up, and then eventually they get trapped and they scale in lower. And so what do you think bulls are going to do if the market lets them out back at their original entry price? That's why we're going sideways here and we're hesitating. Because now you have bears, they see this leg, they're hoping the retest is weak and we get a double top major trend reversal and maybe a measured move down of the double top. And that would be all the way down here. The bulls obviously are hoping that we do the opposite and continue up. But what's happening on the daily chart is we're going sideways. And so the expectation for the day is a trading range day. And even with no information, you can expect a trading range day about 80% of the time. And most days have at least 4 hours of trading range price action. And with that, we'll go ahead and get into the 5-minute bar by bar. You'll notice I have the open of the week drawn. Just because it's Wednesday, I want to have an idea of where the open of the week is. And then I have the high of yesterday drawn and the low of yesterday. The high actually needs to be adjusted here. And so, bar 1, we gapped down, and bar 1 was a bull bar with tails. And so it's a bull trend bar, but it's completely below the moving average. Probably buyers below, and we might go a little higher. We have a breakout point above the bar 81 low. Because there was a gap down and the market's in a trading range, we know that most gaps close in trading ranges. So reasonable to buy and maybe look for a test of the 81 low, maybe the 80 low. Probably going a little higher, but there's no urgency to buy here. It's really just a trading range with a lot of overlapping bars. And then bar 2, it's an inside bar, so more overlap. Inside bars reduce the probability of breakouts, so any breakout you get will likely get retested before long. And it's a low 1 short, probably buyers below bar 2. And then look what happened on bar 3. And again, I'll explain the concept of low 1s again. So you have a gap down, and that's a bear breakout. And actually, I've never drawn this on a review. I'd like to visualize what I'm actually talking about. Because if you study Al, you know he says gaps and gaps and spikes and breakouts, climaxes, they can all really be used interchangeably. There's a reason there's different terms, and you use them for different scenarios. But with the gap down, the point I'm trying to make is that it's basically equivalent of having a bear bar like this. And so if you have a bear bar like that, And then you look at what happened on bar 1. I know this is not ideal, but if you can imagine this bear trend bar, and then you get this bull bar, you have bears who sold the close of the gap, so basically selling the open of the day, betting will continue down, or worst case, they can scale in, get out at their original entry. So what happened on bar 1 is we had a bull trend bar, and bears who sold were disappointed, and they'll use any bounce, any retest lower to get out of their shorts, and they'll look to sell higher. And the bulls know that, so bulls will set limit orders to also buy below the low 1, bar 1, or bar 2. And that's the reason we went outside up on bar 3. So now bar 3, we have an outside bar, but outside bars are trading range bars. It's really an expanding triangle, and that's the risk you face. If you're buying bar 3, you're buying high in a trading range. Now I did say there's an open gap with the bar 81 low, so we might go a little higher, but really not an ideal place to be buying right here. And then bad follow through on bar 4. So if you did buy, say you bought the close of bar 3 and bar 4 is your entry bar, how are you feeling about the trade? You're likely disappointed, and disappointment is the hallmark of trading ranges. So probably sellers above 4, but we might go a little higher before the sellers come in. Bar 5, we had a bull bar, but small body and relatively big tails. It's a trading range bar, and some traders will say it's 3 pushes up on 1, up on 3, up on 5. So it's a wedge, but there's not a lot of selling pressure, and the bars are overlapping, but this was enough up that any pullback will probably result in a second leg up. So it is 3 pushes up, but it's a nested 3 pushes. And if you look at the higher time frames, like the 15-minute chart, you can see right here, it's just a bull trend bar closing near its high. So we traded below bar 5 on bar 6. It was a micro channel since bar 3. The odds are there were buyers below, and there were buyers below. But now bar 6 is a high 1 with, it's not a strong signal bar. It's really just a doji, and we might be high in a trading range. Probably sellers above, but we still may get a deeper pullback and then a second leg up. And then we went outside down on 7. So bull breakout, that failed and reversed, and we have an expanding triangle on a smaller time frame. So what about selling below 7? Like I said, it's an expanding triangle, so you face the risk of selling low in a trading range. Plus, might be a bull breakout, pullback, and we may get a second leg. We have the high of yesterday that we may test. And then another bear bar on 8. So this is a bad high 2 buy. You know the odds are there's sellers above, and this is disappointing for the bulls. We're really just mostly going sideways, so make sure you're buying low and selling high. Bull bar 9, but that could be the second leg for the bulls. We may go a little higher, maybe a more symmetrical second leg, but that is the minimum requirement for the second leg for the bulls. And because of the placement, we're high in a trading range, and the breakout was weak. It has dojis and overlapping bars. This may be all the bulls get. The bears, they're looking to sell above 9, betting that the bulls will fail, and they'll create a double top. And bar 10, we got that double top. You can call it a double top with bar 7 and bar 10. Probably buyers below. It's a tight trading range, but bears will sell below 10, betting that it's a double top, early high of the day, and swing of the day. The problem with bar 10 is that it's an inside bar, and there's a tail below. So if this was such a strong double top, why were traders buying into the close of bar 10? You have to be a little suspicious. And then 11, we triggered the double top. It's a low 2 below 10, but the entry bar is bad. So if the signal bar is bad and the entry bar is bad, that's a recipe for disappointment for the bears. So we may go a little higher before bears will short again, like maybe to a new high of the day. But the problem with 11 for the bulls, it's a bad high 2 signal bar and 2 consecutive bear bars, so there's probably more sellers above. 12, we have a bull bar breaking out of 11, but totally overlapping this tight trading range. Better to wait for a breakout. This is limit order trading. You have traders selling above bars and buying below bars. The market is in breakout mode, and if you enter on a stop, it's an easy way to get chewed up, and I would not recommend entering on stops and hoping for breakouts in a tight trading range. Small bar on 13, you can call it a triangle. I'll draw it so you know what I'm talking about. But again, it's just breakout mode. So the market's getting squeezed, and it's probably about 50-50 bull breakout versus bear breakout here. But for the overall expectation on the day, remember, I am expecting sellers at the hive yesterday, and so I don't think there's all that much room to the upside. What the market might be doing here is, I've said this before, most bars go the wrong direction first, and then they reverse and go the other way. So on the daily chart, we've had about 12 or 13 bars up here, but this could simply be an upper tail on the bar, and then we could reverse. And that's the case for most bars. Bear bar 14, but really just within the tight trading range, probably sellers above and buyers below. And we went outside down 15, we're getting the bear breakout. Now the bears need follow through, and why didn't 15 close on its low? So the problem that the bears face here is it might be 1, 2, 3 legs down after a bull breakout. This may be leg 1, pullback, leg 2. And so you will have traders buying the close of 15, betting that this bear breakout will fail, and those traders are disappointed bears disappointed in the signal bar or entry bar, the breakout bar 15 being an outside bar and having a tail below. And you have bulls betting that this rally was strong enough for a second leg, and now we've had 3 pushes down. The bears are exhausted. They won't look to sell for another couple legs up, maybe 10 bars. And so you have traders buying on the close of 15, and that produced the inside bar on 16, a bull bar, closing near its high, but totally below the moving average. And again, it's an inside bar, and that reduces the probability. Still breakout mode, but maybe a slight bias that we're going to get a second leg to the upside for the bulls. 17, low 1 short, and you have disappointed bears on 15, and they may have been trapped on 16. And now we have a low 1 signal 17. The odds are there are buyers below. And there's actually a sense of urgency. It looks like traders gave up in 18. It's sort of a small example. It's minor, but it's a give-up bar. You had bulls and bears looking to buy lower, and the market didn't get there, and they would be forced to chase the market up. So now we have 3 consecutive bull bars up to bar 18, but there's tails on every bar. There's a lot of overlap. And what's bar 18 breaking out of? It's really just within a trading range. We're getting 3 legs down. Maybe we get a couple legs up, but I do think the upside is limited. This was probably enough for the bulls to get a second leg up, and this may be the start of the second leg from here. Another bull bar, 19, and that's good for the bulls, but the reality is this is not a strong breakout, at least not yet. So if this is going to be a big bull trend day, I know that I'll have plenty of opportunities to buy later. I just want the market to prove to me that it is strong and that we are going higher. But for now, look at bar 19. It's almost completely overlapping bar 18. And now we have up to 18. The high of 18 to the low of 19 is an implied pullback on a smaller time frame. And then we're going up again on 19. So we might have a nested 2 legs up here and 2 legs up here. And remember where we are. We might be high in a trading range. So I do think it's dangerous to be long up here. And then a bull breakout 20, but it looks like the bar closed around its midpoint, maybe below. There was a tick gap, which means the open of bar 20 opened above the close of bar 19, and that can be a sign of strength, but it can also be a sign of exhaustion. And when you consider what I'm saying and the context, I think more likely it would be a sign of exhaustion. The market is getting vacuumed up to resistance. We're breaking out to a new high of the day. The bears are hoping we get a lower high, and then we reverse back down. What's wrong with this bull breakout? I said it's weak. If you look at Al's books or in the trading course, characteristics of strong breakouts for bulls, so strong bull breakouts, you have uniform sized bars, you have bars closing on their high, there's little overlap. I actually have a good example from the other day, right here. So let me just get rid of some lines here. So look at the breakout right here. And if you can remember the breakout that I'm talking about from today, compare it to this one. You have 3 consecutive bull trend bars with small tails. They're closing near their highs. There's little overlap. The market's moving a far distance, and you can argue what's it breaking out of. That's true. And for other reasons, I do think this was a good bull breakout to expect a measured move up. But the point I'm getting at is, pause the video, take a mental screenshot of this breakout and compare it to what we're getting today. We're getting bars that are not uniform in size. We're getting overlap. We're getting tails. The context is bad. And you'll also notice bar 17 did not close above the high of bar 16. Bar 19 closed at the high of 18. So this could be a lot stronger for the bulls. And so might be 2 legs up, and the bears are looking to get a double top here. It is maybe 5 or 6 consecutive bars up in a micro channel. So you might have buyers below, but I still think the context is bad. And if you're buying here or buying a pullback, I think it's risky because you might be buying late and high in a trading range. 21 is an inside bar. It's a doji, and it's a high 1 signal bar. And what do I say about high 1s? They're disappointing, and the rally itself is already disappointing. And the bulls really needed to do something more special with bar 21. And so because it's disappointing, the odds are there were sellers above. The only problem I have with bar 21, I always say high 1, probably sellers above, but the reality is that's the sort of gold standard. It's the ideal entry, and that can be greedy. So you can set a limit order above 21 to sell, but you're not guaranteed to get filled and get into the market there. Remember, you need an institution to do the opposite. You need an institutional bull to buy above 21. And you just know that the odds favor sellers above. And when that's the case, you might also have sellers on the close of 21 front running the sell. And if the market starts gaining momentum, it's not going up, traders might start entering the market at the close or at the market and chasing the market down. So that's my concern with selling above 21 here. And that's what happened on 22. Markets are fractal, and so 22 is still a high 1 signal bar, and we could easily trade above it and then reverse back down. And if you're a bull, you have 2 legs up, and then you have a doji and then a bear bar. And you'd be happy to, if you bought the close of 20, and this was your follow through, you'd be happy to exit at your original entry, the close of 20. And then 22, bar 23, there's a small tail on the top of bar 23, but it couldn't even get to the close of 20. That's a warning. There's a sense of urgency. Bulls are exiting below the close of 20. Bears are entering. Now you could argue it's leg 1, pullback, leg 2, and a 50% pullback of this rally, and that is the risk that bears face here. But I think it's probably always in short. The reality is it's buy low, sell high. We're in a trading range, but if I had to choose, I would be short. Doji on 24. I want to make one more thing clear about bar 23. When you get a bar like 23, it's really important to understand stop order traders and what's happening on bar 23. Remember the gap down. We had a bear breakout, and then we had one leg up. It's a weak rally with dojis and overlapping bars. The bars have tails. They're not uniform in size, not breaking out of anything to the left. And then a second leg up with problems itself. So now you're getting a big low 2. We have a low 1 here, and then a low 2 here, and a lower high. And it's bar 23. And you know that the market often creates the high or the low of the day by bar 18. One more thing I forgot to mention, I should have mentioned, which goes along with this well. There's a 20% chance that on any given day, bar 1 will remain the high or the low of the day. And when you're expecting a trading range day, and in this context especially, you know the odds are we're going below bar 1. And that's the risk with staying long below 23. 23 is a bar that you have to respect, as in always in flip. And so if stop order bears are shorting below 23, that means strong traders are selling below 23, and it's probably more than a scalp. It might be a swing. Al talks about catching the opening swing. This could be a double top and then a reversal. So 23, get out of longs below it, and okay to short. 24, disappointing entry bar, but good signal bar, and you know the odds are there's sellers above. It's a 4-bar micro channel. The bear breakout was strong enough that it'll probably get a second leg, so okay to hold short here. And then 25, we're continuing down, still probably sellers above. You're running into support to the left. The bulls are hoping there are buyers below 15, and there probably are buyers below 15. Inside bar 26, but minor. It's really bears taking profits. Would you really want to buy above such a small bar? It's an inside bar, and after this sell-off, the odds are this is not going to reverse all the way back up to the close of 20. The bulls, they're disappointed, and they'll probably wait to buy lower. Low 1 short 27, and I think it's reasonable to sell below 27. You also have traders selling above 27. It's a bad high 1 above 26, and then a bad entry bar for the bulls, and still a tight bear channel and a leg 1. 28 is a bear bar closing on its low. That's good for the bears. Probably going at least a little lower. Like I said, the low of the day might be a magnet because at this point, the odds that we've seen the low of the day are, 20% at best. 29, we had a bear surprise. 29 is a big enough breakout. You know the odds are we're going to get a second leg. The problem is that we're in a trading range, and when you get decent breakouts like 29 in trading ranges, you know you're going to get a deep pullback, and the second leg is going to be delayed. So how is 29 a decent breakout? I said it's a decent breakout, but there's a giant tail below. The reason is that distance is more important than the close of the bar. And you can see we moved a fairly big distance on bar 29, well beyond the average bar size of the day, maybe, 4 or 5 times the size of the average bar. And because of that, you have bulls who bought the low of bar 1, they got trapped, and they actually have this deep pullback where they might be lucky enough to exit at break even on the next bar. But if they do get to that low of bar 1, I think the odds are we'll find more sellers and the market will get a second leg down. Bull bar closing on its high 30, but inside bar and tight bear channel, you're expecting sellers above. You're expecting bulls who bought here to take this pullback as a gift. And if bulls are exiting longs and bears miss the short, they're looking to sell higher. There's an imbalance, and you have traders selling above, looking for a second leg. 31 is another bull bar, but still within the bar 29 range, and it's a smaller bar than bar 30. So why is the follow through of 30 on bar 31 such a small bar if it's a strong breakout? The odds are it's a minor reversal. 32, another bull trend bar, testing the moving average, testing the breakout point 27 low. You had bulls buying here, betting maybe tight trading range final flag before a reversal up, and they got trapped. And what are those bulls going to do on the retest? They're probably going to buy back. They're probably going to sell out of their longs. 33, another bull bar. A little bit of a surprise. Crossing the moving average, but where are we? It's possibly something like a 50% pullback, maybe deeper. Yeah, we're at about a 70% pullback of this bear leg, but it's so likely we're going to get a second leg, and 70% is a common level for traders to sell at in a trading range, and I'll keep that up. I just wanted to keep that up for one more bar to see what happened and to demonstrate that we paused at the 70% level. So low one below 34, but do you really want to sell below a small reversal bar after 4 decent bull bars up? Probably not. The bulls are likely going to get a second leg before the bears continue. So first entry, short, probably going to find buyers below. But I do think buying here is risky because this is a more major breakout than this. This is probably more of a pullback to this, and this might get a symmetrical second leg. Outside up 35, and we expected buyers below 34, and that's what happened on 35. And now 35 is the minimum requirement for the bulls for getting their second leg. So we had one leg up to here, 33, pullback, maybe second leg before we sell off again. It's tight enough that may not be the case, but again, I'm hesitant to be long here because I still think we are always in short and probably going to get a second leg down. Inside bar 36, probably sellers above. And the same problem that happened with 21. There's probably sellers above 36. And if you wanted to sell above 36, you never got the chance on 37. 37 is a high too, and the context is bad. It's a bear bar. It's a buy reversal bar, but a bear close. And it's a bad signal bar with bad context. The odds are there are sellers above, sellers on the close. 38, it's not much better for the bulls. It's just a doji. We're in a tight trading range, probably sellers above, and still expecting some sort of second leg down for the bears here. 39, bull breakout attempt, but possible buy vacuum test of resistance to the top of this tight trading range. You had a breakout point here below bar 21. We might be racing to that. And this could be the second leg up. We had leg 1, pullback, leg 2. Now, leg 2 is not always symmetrical, especially when the leg you're talking about, this leg 1, is more likely a flag. The reason, again, why I think it's a flag, why I think it's a minor breakout, is that this bear breakout was stronger. And with the bar 18 reversal rule, the 80% chance we've seen the high or the low of the day, at this point, I don't know, it might be 50-50. Maybe somewhere in that range that we've seen either the high or the low. But again, with the daily chart context, with this being a stronger breakout, I do think there's a higher probability that we've seen the high of the day and that 39 could be a bull trap. And there were sellers on the close of 40. On the close of 39 on bar 40. 40, you can see it was a buy vacuum and just testing some resistance level before all the bulls exited and all the bears shorted. So surprise on 40, strong enough, we're going lower. 40 is another bar like 23. You need to respect it. We're probably going lower. It's always in short. What if it's in expanding triangle? You might argue that, but you need the trade to go your way really quickly. And it's an aggressive trade. If you're buying the close of 40, you need 41 to be a bar, similar in size to 40, but a bull bar, and it needs to race up probably within the first minute of your entry bar. And for the bulls who bought, let me back up. For the bears who shorted below bar 40, it's a disappointing entry bar. But the signal bar was so strong, and the context is good that we're going lower. I think the minimum is the bar 29 close where bears got trapped because it's a trading range. Trading ranges are forgiving, and when traders get trapped, the odds are they'll be able to scale in and get out at their original entry price. Remember what I said down here? This was a strong enough breakout that you're expecting a second leg, but the second leg is going, first of all, you're expecting a deep pullback, and the second leg will be delayed. Well, we've had the deep pullback to about 70%, and now the market's reversing back down with a strong bear bar 40. Do you really want to buy 41? It's a doji bar after a strong bear bar, completely below the moving average, and you're fairly high in this trading range, so the odds are there are sellers above. 42 triggered the buy above 41, and it was disappointing. Low one short 42, and in this context, I think it's reasonable to sell below 42 as a low one. It's not ideal, and there's probably a better sell above 42, but the bulls run the risk that we're going to get a second leg down somewhere here, maybe down here. And let's also keep in mind the daily range today is small, and the odds are we'll probably get a measured move based on the height of the trading range. Is it the opening range? Maybe this. Maybe the opening range is here, and we'll get down here. I don't know, but I do think the odds are we're going lower and not higher. I also think there are buyers below yesterday's low, which I will redraw. $43 going higher, sellers above 42. It's two legs up after a bear breakout. They are expecting to get a second leg. So I think danger is to be holding long here, and bears are probably selling the pullback. 44, another bull bar, but overlapping 43 and totally within the range of 40. The odds are it's a minor, and it's probably sellers above. 45, another bull bar. The problem I have with this bull breakout is it's probably a second leg, and you're high in a trading range. So leg one, pullback, leg two. And this could be a breakout pullback of 40. Remember, when you get a strong bar or strong breakout like 40, but you're in a trading range, you're expecting deep pullbacks and delayed second legs. And that applies to this bar as well. So 40, it's a good bear breakout, but nobody wants to sell bar 40 because it might have been an expanding triangle. We're probably low in a range. So traders will prefer to sell higher. And I think that's why price is climbing. I think it's a lack of sellers more than aggressive buyers. Aggressive buying looks like the strong breakout I showed earlier in the video. This is more similar to this rally, where the bars are not uniform in size, prominent tail above 43, overlapping bars, overlapping the bars to the left. More likely, we get a test of 39 and then a double top. 46, there were sellers above, and now we have a bear reversal bar closing on its low. Always in flip. I don't know if we ever went always in long, but I do know that if you are long, that it's wise to get out below a bar like 46 here. Tight enough up, this might get a small second leg, but I think that's the best case for the bulls here. And if you're buying, I would not scale in. 47, another bear bar, high one, probably sellers above. And then again, on trading range days, you can see traders who want to sell above are not getting filled. They need to chase. So it's probably better to sell the close of 47, and that's what traders did on 48. Bear breakout 48, 3-bar micro channel, probably going lower. And for the bulls, hoping for a second leg. They're hoping 48 is a vacuum test of support, maybe a 50% pullback, and it might be. Here's 50%, but they need the next bar to go their way quickly, and if it does not, they will probably get out of their longs and look to buy lower. And then we had a tick gap on bar 49. The bar opened below bar 48's close. We're crossing the moving average, 4-bar micro channel. And again, big leg one here, complex pullback. This might be the start of the second leg. And if that's the case, we could easily get vacuumed down to a new low of the day. It's a trading range day, so I do think there's buyers below. And one more thing, it's 1:35 Eastern time at this point. So you're getting to that point where it's probably wise to not be in a trade going into the FOMC minutes report. But you can see it's also reasonable to be short. It's always in short, and the context is good for a swing down. And then the next bar 50, we had a bear surprise. It's similar in size, or it's similar to bar 29, but it's a much bigger body and it's a stronger breakout. The problem is that it's 3 legs down in a trading range day. So you will have traders buying here, buying near this line. The only problem I have is, do you really want to buy after 5 consecutive bear bars in such a big bar here? Some traders will buy for a scalp, but I think that is the most you can do. I would not be buying here for a swing. Might be collapsing down to test the open of the week. We might be headed to yesterday's low. Follow through selling on 51. So if you did buy this, possible wedge bottom, expanding triangle, if you did buy and say you bought below this bar and this is your entry bar, you're probably disappointed. Now most breakouts pull back, and traders who did buy will probably get a chance to exit. But again, it's always in short and hard to find a reason to buy here. 52, we get a bull bar, but it's a trading range bar. The odds are there are sellers above. Inside bar 53, but low one, probably buyers below and going higher for a more complex pullback. That's what happened on 54, outside up. Bull bar closing on its high. So some traders will buy above, but the reversal is probably minor. And then this is the report bar, 2 o'clock Eastern time. Big bear breakout. So we had a bear breakout, and you expect a second leg from this. 1 pullback, 2 legs, and then another breakout. By the way, this bear breakout had about a 30% pullback. So I have the 30%, 50%, and 70% pullback levels because those are the most common. And you can see bear breakout, pullback to 30%, could not get above it. And then, everyone will say, for whatever reason, the Fed hiked interest rates or whatever the report was, that's why we're selling off. But the price action, the point I'm making is that the price action actually makes sense. Inside bar 56, but tail above, minor reversal, probably sellers above. Now the one concern here is if you look at the selling by the bears, it's great and all that we're getting lower prices, but the reality is this is unsustainable. And so we had a sell climax here, sell climax, sell climax. We're getting consecutive sell climaxes on a trading range day. And remember what I said about it's hard to predict what the market will do on the report, and it's better to wait for more information. So we're still just maybe 10 minutes after the report. So probably better to be flat and wait for more information. Because it's a trading range day, because I expect buyers below the low of yesterday, I do think we might bounce here, but this was strong enough that it'll probably get a second leg before we go up. Low 157, probably buyers below. Consecutive sell climaxes. We may get a third, but that might be all the bears get. The low one triggered on 58, and now it's a bad buy signal bar, so probably sellers above. And then we sold off on 59, but it's a third consecutive sell climax with big tails below. The bears have controlled more than 10 bars below the moving average, and that's good. But all things considered, trading range day, weak bear breakout, it's really just sell climaxes testing for support below. This was such a fair price earlier in the day, the odds are we'll come back and test a breakout point, like maybe the bar 29 low. Bear breakout 60, it's a bar closing on its low, but it's a third leg down, and it's risky to be selling after 3 legs down. Third legs have the lowest probability of getting subsequent legs, and so as strong as this breakout looks, you have to ask yourself, what's the context? We might be 20 bars into a parabolic bear trend, and as strong as the bar is, everything has an opposite. So sometimes when you get a strong bar like 60, you'll have traders buying the close, betting that it's exhaustion, and betting that we will actually reverse sooner than go for a measured move down. And then if traders did sell the close 60, 61 was disappointing, and the odds are there were buyers below. Bears who sold 60 were able to scale in or at least exit at their original entry on the close of 60. That's what took place on 62. Low 1, probably buyers below. We might be putting in a low of the day because of the characteristic of the possible day structure. Do I think we're going to continue in this bear channel all day? I really don't. It's not impossible, but I do think it's unlikely. And I think we'll probably bounce back to maybe the open of the week or some breakout points above. We have an open gap below 52. It's a negative gap. The tails overlap, but the bodies don't. And that's a gap on the line chart. And the market might come back and test that level as well. 63 triggered the low 1, but it's a disappointing bar. It's a trading range bar, probably buyers below. And then 64, bull breakout. It's a bull bar closing near its high, and 64 is an always in flip bar. I'm not sure that it's always in long yet, but I do think if you were short, it's wise to get out of shorts above bar 64. Bears able to prevent the bar from triggering, but is 65 strong enough to reverse 64? 64 was strong enough that it'll get a second leg most of the time. And we have an open gap from the 63 high and these bars to the left. So this might be a breakout pullback before we get buyers below 65. And that's what happened on 66. Bull breakout, pullback, testing breakout points. And bears who sold scaled in. They got out at their original entry. Bulls who missed the buy, they set limit orders here and they got in. Now we have a high 166, possibly low in a trading range, and possibly always in long. I think it's reasonable to get out of to buy above 66 and to get out of shorts above 66. Bull bar 67, closing on its high, good for the bulls. 68 going a little higher, but the bar is getting smaller. The bears, they're hoping we had a bear breakout, two-legged pullback, and then second leg. This is 2 legs up, but on some higher time frame, it's one breakout, it's one leg, and this whole leg might get a pullback before a big second leg. 69, bear bar closing on its low, but probably minor. Again, this was strong enough that any pullback will probably lead to a second leg. And weak traders, 68 was a low 2 signal bar, but a bad signal bar. And the context is bad. It's a parabolic, sell climaxes, and then a really deep rally for your pullback. So not ideal. It's really not a bear trend where you're looking to sell a low 2 at the moving average. Outside down 70. But look at the past 10 bars or so. The market has been sideways, so bear bar, but do you really want to sell at the low of a trading range? The odds are there's buyers below. And then a bull bar closing on its high, 71. Second reversal up, another bar that you need to respect that might have stop orders above, and we could easily rally here. And if you think about the daily chart, is today going to be a bear bar closing on its low, or was it mostly sideways and then we had sell climaxes and more sideways? I think the odds are I should have drawn this too, the middle of the day, the midpoint of the day is probably a magnet. And that would be here, which is close enough to the open of the week, so I'll just keep that one drawn. The bear's also hoping we got a bear breakout of yesterday's low, we get a pullback to test the low, and then we sell off again. And the bull's hoping we just rally straight through it. 72, high 1, and possibly early in a market cycle, we had a bull breakout, might be low in an overall trading range. 72 closing on its high, still a bar. I would exit shorts above, and it's okay to buy above for a swing. 73, a good entry bar for the bulls. The bar crossed the moving average. It has a big body, does have a tail above, and you can see there were traders selling at the open of the week, but that was mostly bulls taking profits and not bears just selling on limit orders here. Now the market probably is in a trading range here and not a bull trend. Now we've had a couple legs up, but this leg up was strong enough that it'll probably get a second leg of its own. So we had profit taking and a pullback on 74, but inside bar, probably buyers below. 75, good bear bar, but testing breakout points where bears got trapped. So bear breakout, but breakout of what? It really could be a deep pullback of this rally. And if we're in a trading range, pullbacks get deep, breakouts get deep, pullbacks before second legs. 76, bear bar, but getting smaller and overlapping 75. So not ideal for the bears. And then almost an outside bar, 77, bull bar closing on its high, double bottom, and another bull bar closing on its high in this area where it's okay to buy for a swing. So bears, if you're short, probably get out above 77, and some bulls will buy for a swing. 78, another good bull bar. But now we have possibly 3 legs up, and we're at resistance, the open of the week. So as strong as that bar is, it's also late in the day, and we'll probably go more sideways than up here. And instead we went up on 79, so strong bull breakout, but so late in the day, kind of too late to do anything. The market closed this gap below 29, and then selling on bar 80 and 81, a little more selling into the close. For always in today, always in is always tough in trading ranges, and it'll always trick beginners. When you think of always in, the market will look like it's doing just enough to become always in long. We have consecutive bull bars. It's a micro channel. The odds are there's buyers below, but the context is bad. There's so much overlap, and look at the overlap with yesterday. So because always in is sort of opposite in trading range days, you can expect that here the market might actually be always in short because of context, even though the price action might be deceiving. Probably always in short through here. I thought 23 was definitely an always in flip. I'm not sure we ever went always in long. Maybe briefly here. This was a solid bull breakout, but the context was bad. So we'd probably get a second leg, but not too much. And then over here, somewhere in here, whether it's 46 or 48, I thought bulls really had to get out of longs again. And the risk was real that we'd collapse down, which we did. The reason I would expect a collapse on a day like this is because of what happened here, and it's a trading range day. And if we're getting high in the range and bulls are unwilling to buy, you need to go lower to find buyers. And no one wants to buy in the middle of the trading range. Traders want to buy at the low of the trading range. So probably always in short here. And where do we go? After 3 consecutive sell climaxes, even here, I think it's risky to be holding short. And then, like I said, bar 60 can be deceiving. So 60 might be the start of an always in flip to long, but that's a really aggressive idea. Disappointment here, starting to go sideways. Might be always in long above 64, and that's why I would get out of shorts above it. And then to go always in short here, I don't think so. I think it's a trading range, buy low, sell high, but the bullish bias, probably always in long here. Another deep pullback, but probably not enough to be always in short. You're totally overlapping this bull breakout. It might just be a deep pullback. And it was. It's probably always in long up until the close. For stop order trades today, I thought you could sell below bar 7, but it was a weak signal bar, and you needed your entry bar to be impressive, and it wasn't. So traders who sold below 7, they were disappointed, and they exited on the next bar. I thought you could sell below bar 10, but similar situation. Context isn't good. You're in a tight trading range. So traders will sell below bar 10 and take a chance. But if the market doesn't go their way quickly, they'll exit the trade and they'll give up. And that's what bar 12 showed. I thought bar 16 was a wedge bull flag and a reasonable buy. Was it ever by the close in that rally from 16 to 20? I don't think so. I think it was too weak and the context was bad. About 23 was a reasonable stop order sell. And I thought bar 30 was a reasonable stop order buy. You have a sell climax and you're low in a trading range and you're expecting a deep pullback, even though you're expecting a second leg down for the bears. You know the bears don't want to sell low in a trading range. And then as far as selling 34, I would not. It's too tight of a bull channel. Nothing great to sell in here. Traders might sell 40, but the problem with selling 40 is, if you put a stop above 40, that's exactly where you should be selling more. And the major higher low, or the major lower high, is bar 20. So the stop goes up here if you're selling here, and you should be willing to scale in. I thought 46 was a better stop order sell because you're higher in the range. You have consecutive attempts up by the bulls, but the probability is low, and the probability is still low on 48. But once you start getting this tick gap and 4 consecutive bars, you can see we got the give up bar here on bar 50. Probably sell to close 50, 51. And what about here? It's the FOMC minutes. I think it's better to be flat. I thought there were buyers above 64, buyers above 71, buyers above 77. And for limit orders today, I thought bar 2 was a good low one to buy below. 3 pushes up, probably sellers above bar 5, and they came in above 6, bad high 1. And all in here, it's traders buying below bars and traders selling above bars. So you have buyers below, sellers above, buyers below, sellers above, all through here. For this bar, bar 26, it's a bad high 1 after a tight bear channel. Probably sellers above. Through here, I thought buyers below 34. Buyers below 36, another bad. It's a low 2, but bad signal bar and too tight. Probably going to get a second leg. And then over here, sellers above these bars, but they never triggered. And then as far as buying on limit orders over here, I think it's better when the market is having sell climaxes and is volatile to be entering on stops when there's a more credible bottom. Now traders will buy below a bar like 55, betting we won't go much lower, but because there's not much information to the left, if there was more overlap and a lot of bars here, then there's probably limit order traders below. But until there's that, I think it's risky and probably wait for more information. Now I thought there were buyers below 65, bad low one. Buyers below here, tight enough up, probably get a pullback and then a second leg. We got a deep pullback, but there were buyers below. Buyers below 71 if we get there. Buyers below this, you don't know where exactly, but breakouts in trading ranges get deep pullbacks, so probably wait until at least a 50% pullback, if not deeper, to enter. And then limit orders came in around the breakout, the start of the bull breakout on 71, double bottom. And then maybe sellers above, maybe 3 legs up, but obviously we got the bull breakout and then pulled back after. Please, if anyone has any questions, just leave them in the comments and I will get back to you as soon as possible. And thank you for watching. Hope everyone has a good rest of their night.